So the market recovered during the drawdown in the market from the oil crash or the oil crisis. Prices got worse and worse and worse. And the market bottomed on October, pretty sure when everyone was fearful. And it shot back up during 75. Then by 76, the market stayed still. By 1976, there was global inflation from the dislink of gold in the US dollar. On 77, right, if we look at this period during 76, the market really stayed still. It shot up beginning of January. But during the rest of the year, the market really stayed in a lateral trend or consolidation. And by 1977, the market went down completely. If we look in this period, what were the causes of this drawdown? Well, looking at this article and looking at this one too, there was a major international development in 1977. While there were a number of developments in 77 which were noteworthy for their impact on the international situation, such as the start of the Carter administration in the US and the reinstatement of Vice Premier, I don't know if I'm pronouncing this right, Ting Xiaoping, and the establishment of Huai Kuofeng leadership. I'm sorry if I don't know how to pronounce Chinese names quite right. In China, the year 1977 may be termed a year in which no solutions were found for the various political and economic issues pending since 1976 and before. On the international political scene, such pending issues at the Second Strategic Arms Limitation Talks, which was SALT II, the Middle East peace problem, and the problem of Southern Africa and the normalization of relations between China and the US, were carried over for settlement in 78 and beyond. Moreover, such developments as the friction between the Soviet Union and the US over the human rights problem and local conflicts on the Horn of Africa and elsewhere added to the list of the destabilizing factors. So on the international economic scene, on 1977, there was a spread of protectionism, increasing trade friction, and international currency unrest, while the major developed countries suffered from business stagflation, unemployment, and inflation. Nor were any basic actions taken to resolve the energy problem. Remember, that was back in 73. This is about 4 years later. Thus, the world economic situation did not improve to the extent expected, although continued efforts were made to promote the dialogue on the north-south problem. Many difficult problems remained unsettled. So the main issues why the market went down in 77 was because there was a fear of geopolitical problems as protectionism, trade frictions becoming much more tougher, international currency unrest because of the Bretton Woods Act that happened 6 years before, and that played a bigger part years later because people can't lend easily from throughout the US because there's no more gold to link it to. And the US also had the business stagflation with unemployment and inflation. So you could say that finally the consequences and problems that happened in 71 with the dislink and the continued inflation, most of all with the Bretton Woods Act. The Bretton Woods Act has responded towards a bigger effect after 6 years later, because the trading there is much more harder. People don't want to lend their money as much, especially with an inflationary era. And finally, that came to a realization that the problem needs to be confronted, and that was reinstated in 1977 to 76. That's why the market went down, because of the Bretton Woods after 6 years later. And then by 1978, the market bottomed and it shot back up. Right? It always does that. When the market goes down a lot, it's likely to shoot back up. It went from 735 to 916. Now, you might be saying like, but wow, ever since 766, we bought at 496, and right now the market is at 741. I mean, that's not 100% gain. Yeah, but we're in a very special time in the US economy, in history, and where they're finally encountering the problem of the cumulative issues they've had with the baby boomers, with the Vietnam War, with now the energy crisis, with a lot of this geopolitical issues constraining and a lot of free, let's say, trade with the US onto currencies wanting to fund throughout the US dollars, convert them into gold. And during this time when the US dollar was becoming very inflated, part of the reason why the Bretton Woods, so you guys can know, was dislinked was because everyone was exchanging their dollars to the gold because they saw how the US dollar was overvaluing itself, and they were fearful that it would track back to the gold, which would make it worthless. And that's why, from its worthless value that they were seeing, they wanted to quickly exchange their dollars to gold. And that kept happening in high amounts towards the US saw that they almost had no gold left, and it was a bad situation that they had to dislink the gold from the US dollar so people would stop converting their gold, because that's the US in that time. That was a big portion of the US's wealth. It was the gold it had back 20 years ago. That's been receding as time went on because other countries wanted to slowly exchange their currencies with gold. And that became worse during the end of the 60s. That's why in 70 and 71, Bretton Woods ended, right? And then all the accumulated problems geopolitically with the coup war and the energy crisis, all this accumulation has corresponded towards the drawdown it did. But regardless of the reason, the market went up. It shot back up. Another article here. Earlier this year, as the economic, and this is cool, wow, this was in 1977. This was written in 1977 on August 8th. Earlier this year, as the economic recovery picked up momentum, some savvy Wall Street professionals were predicting that the stock prices would zoom and the Dow Jones Industrial Average would easily soar beyond the peak of 1,051 it reached in 73. So much for savvy. Since January, the stock average have wobbled and worried their way down steadily. Last week, the 77 market's peevishness turned into something approaching panic, as the selling stampede slashed share values and drove the Dow down to its lowest level in 18 months. The slide began earlier in the week when both Exxon and U.S. Steel, Exxon in that time was a huge company. Yeah, Exxon was one of the biggest companies in the world, announced lower second quarter earnings. Then on Wednesday came a shocker from Behemoth Steel that reported an operating loss of $75 million for the first half, and in result had to cut its dividends. With that slide, it turned into a slaughter in frantic trading. The Dow plunged almost 20 points. For the week, it closed down 33 points at 890, almost 10% below its January level. Analysts seeking to explain the market's jitters could point to some cloudy economic news. The index of leading indicators, a widely watched parameter of future trading in the economy, dipped down, okay, blah, 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 blah. Yeah, you just have all this metrics. So investors were puzzled by slow progress of the Carter tax and energy programs in Congress, right? Because remember, this always happens. Whenever there's a problem going on in internationally, a lot of the government and Congress are going to try to ease the problem down. And so Carter made apparently a new tax program and an energy program from the energy crisis. They have been concerned about the growing U.S. trade deficit and the fretful that a big increase in the money supply in recent weeks might prompt the Federal Reserve Board to tighten credit and thus triggering a rise in interest rates. Another drag on the market was European investors who have been nervous about the shrinking value of the dollar. Yeah, you see like all these reasons. See, like everything is consequencing itself now, from all the instant decision making, from having a bunch of investors, European investors, shorting the dollar because the dollar is devaluing itself, right? So then that fear forced the Federal Reserve and Nixon to completely just stop trading it. But of course, this prompted into more devaluation with the dollar. And so that affects economically with the division and people having lower incomes and the amount of money that people could spend because it's devaluing itself, how much they can earn. This all reflects to each other. So let me rephrase this. What happened was during the beginning of the 70s, Nixon was forced to dislink the dollar out of the gold because there was too much dollars compared to what there was in gold. And that's a problem because in the long term, as the dollars being linked from gold, dollars is just a unit of a credit, you could say a credit or a leveraged system to get the valuation later. It's like when you promise to pay someone, right? There's value in that dollar because they can easily convert them into gold. But when there's too much dollars compared to what there is in gold, your promises are a bit misleading compared to what you can actually provide in the other person's behalf, right? And so this is a big problem for the government, most of all, for the economy, for the country, because it can result to a big deficit for the country, which could lead them entering into a very disastrous spiral economy where the government can't supply enough for its citizen, or most of all, if the country gets into a war per se, they're very likely to go broke out of that war because they have no relative assets to back up what they can actually spend, which means they'll have to get in debt with other countries. And if they don't have any valuation or a deal that the other countries would be fine, let's say, lending them money, then no countries would lend with them. So you see, that's the problem with it. So many of the officials per se in the Federal Reserve know this nature of the economy. And when they see this very, very big problem with their currency, they immediately urged Nixon to do something about it, and Nixon decided to dislink the dollar at that time. And of course, what this does is that it completely depreciates the dollars you have because it's not linked to gold. So think about it, if there is no backed up asset by the dollars, not only is there's no backed up asset that you're just holding a piece of paper, but many people have the same piece of paper, right? And when there's more printing of that paper, And when you raise interest rates, you're basically doubling down the depreciation the dollar has. Because one, more people have utilization and more accessibility towards dollars. And two, you're decentivizing anyone to, let's say, take out loans, take out credits, buy a house, buy a mortgage, right? And this is what it's called by depressing the economy, which means there's not much demand, right? So that's why you can see what's exactly happening is many things are expensive. Many of the corporations are offering higher prices for what they're giving. And on top of this, you had the oil crisis, right? And that raises up gas prices on top of the inflated prices and overall. So this is a huge problem. You can already see based on the description I gave. And so if companies like Exxon, most of all, or let's say US Steel or Behemoth Steel, let's start with Exxon. A very logical reason that Exxon lost money is because during the oil crisis, well, how does Exxon make majority of its money? Well, throughout its oils. So, I mean, when you're in a company in oil, I mean, you have to be net bullish in oil. You have to believe that over a course of time, oil will go up, right? But a lot of the times during the stagflation with that, let's say, depressed economy, people are not getting to loans, people have a lower income pay, not much people are going to be able to afford their daily expenses as they used to. So not much people are going to, in fact, there was a few regulations to maintain below speed limit.
Off down the road, cruising 55, 60 miles an hour. Well, you can't go any faster than 55 now. So at 55 miles an hour, reach over and push this, and then sit back and relax, because the car will keep a constant speed of 55 miles an hour, whether it be uphill or downhill, round corners or whatever. It'll completely hold itself on the road.
Just one question I'd like to ask you. How many miles to the gallon does it do?
This car will get somewhere between 6 to 8 miles per gallon.
6 miles a gallon? But where am I going to get the gas from?
You've got a big tank in the back. It'll take on 25 gallons at one time, and that'll give you a chance to get to the next service station.
Well, it's a nice piece of machinery.
You like that?
What sort of things do people say to you when they come in to buy a car nowadays?
Gas mileage, that's the number one topic. How many miles to a gallon will this get? And that doesn't make any difference if they're buying the smallest Pinto that we sell, or the Mazda, or the Thunderbird. One of the first questions asked, even before the price of the car, people come in and say, how many miles to a gallon? If I told you that this car right here would get 25 miles to a gallon, then you would be ready to buy it, even if you didn't look down here and see it cost $8,000. The other day, a lady came in driving a big Buick. It was the biggest car Buick makes. Big, heavy lady with her fur coat and her rings and her jewelry and her 3 big, heavy friends. They just left their club, probably, and they come down here with their big car, and they pull on the lot, and they want to see a Mazda station wagon, which is a small car. The 3 of them couldn't get into the car at one time. They were stuffing them in the door, and they were just sitting scrunched up in there, and they couldn't drive the car even. But this is what she wanted, because she was concerned about the gas mileage. You know, she could afford the bigger car, and she couldn't even fit in the smaller car, but that's what she wanted, because when she had to go someplace, she was going to squeeze into it or put that car on, and she was going to whip down to the store. But now she'll buy the little car, but she's going to have to lose some weight or something first. She's having trouble getting in it.
There was a lot of regulations to decentivize people to drive a lot, which of course you guys know that makes anyone who's selling gas to make less money, right? And the thing about oil companies is that they have high capital expenditures. They have a lot of debt. When a company isn't able to produce as they have to, usually to maintain with their expenses, they have to get into loan or debt. And I'm pretty sure that's what happened with Exxon. Exxon got into quite a bit of debt just to help run their business, their expenses, which net in total lowered their earnings. That's temporarily, and that scares the market because many people get scared out of quarter earnings. Now, you don't do that for investing because it's very stupid. You're not buying or you're selling because of some earnings that came out. That's not at all why you invest, but that's a big reason why many people invest. And for steel, on the other hand, I mean, it somewhat has to do related with the oil, but I'm pretty sure it has somewhat more to do with the overall inflation of what's going on economically. The market slump can be related to the dollar's weakness. Europeans are now selling, and they won't be back until we moderate those tremendous deficits. Yeah, and then actually there's much evidence around of continued economic strength in the second quarter. Corporate profits were up more than 11% over the period last year. General Motors quarterly earnings exceeded $1 billion for the first time in the company's history. Real income of employees on non-farm payrolls is up and housing starts are at near record levels. But a pesky psychological climate is overhanging in the securities markets. Of the trust and investment decision at New York City's Morgan Guaranty Trust and Co., everybody's hyper. I mean, first you are worried about the economy's going to be too strong, and you're going to have inflation. And then you worry, my God, we are going to drop off into a mini recession or worse. The worries change, but what remains constant is the worry, a generalized kind of worry, a malaise of freeloading anxiety. You see the problems that were going on to people's minds throughout their day, and these people did not know that literally a few months later the market would bottom and go up like all the way to 910. You see, like no one expected at all that in January 1978 that the market would bottom in March and it would shoot back up to 920. That's why no one has the full answer, right? But you need to be around the area where it can likely go up. And that's when the market goes down. Despite all these reasons, and it's basically summed up to what I just said there's many different reasons, right? So you remember, the more reasons you have, the more it's going to likely come down. You had the inflation, the consequence of most of all the Bretton Woods, the high unemployment from the inflation, the dislink most of all from the Bretton Woods, from people earning less. And then on consequence of this, obviously a lot of companies, including big companies, are going to be reporting losses, which is basic common sense. And so this stuff unfolds to itself on what its cause and effect, and affecting other areas into where people start to sell because of a quarterly earnings, which is stupid, because you never should buy something just because its earnings were positive. That's not how you should invest. If you're Exxon or US Steel, you don't care whether your company is doing well based on what its earnings were now, because you're focused on the long term. You're focused on supplement an area in their statements and put it more into cash. That way they have a broad view in the next 6 years that they will invest into a new operation for their business, which is R&D, and that can give them a more competitive edge in the industry and a much more bigger worth in selling better products, better services. That's the point of a company in their view. That's why it's pointless to invest in companies just because its earnings were positive. I mean, do you think Apple bases its decisions because its earnings were just positive? Do you think that they make a new iPhone or a new management within their Genius Bar because they're afraid that the earnings are going to be negative? No, they don't. No company that does that. But I don't know why. I don't know how this came about. All this stuff, all this junk is always sold by Wall Street, and it never works. So that's what happened in 77. All this accumulation of different consequences. Then the market bottomed. Remember that inflation is going up and going up. So market bottomed, and during this time, then by 78, market really just stayed still. By 78, it didn't stay still, but it bottomed late in March, and it went up and it went down. Then by 79, the market stayed still. So basically, if you look at this, by 78 until 80, for 2 years, the market stayed still. And I'll tell you for sure, for a person who learned from the stock market here, they think that the stock market is complacent because they've only seen what they've seen now, right? But they haven't seen what's happened many, many decades ago. Similar scenarios. Not the same scenario, but it's a scenario that rhymes. During 79, you have extreme inflation by this point. And then finally, we're going now to a famous, legendary. I'm sorry. This looks like a joint. I don't know. I just got confused because that literally looked like a joint. But this is Volker. This is a very legendary figure in the Federal Reserve because he responded in a very unique way towards this bad situation that definitely changed the U.S. economy in the upcoming decades. And let's see what Volker did that was so important. Using the Fed's preferred measure of inflation, personal consumption expenditures, PCE, as opposed to the consumer price index, and that tends to get much of attention in news coverage, we can see that prices began to, this is an additional method. But that doesn't mean that this is someone's opinion on a blog. I just want to see but this is, PCE is an additional method, but I do prefer the more traditional method from CPI, because that's a much more accurate way to find inflation, because it accounts for all domestic products, right? All domestic products, if they go up, we can say from general that inflation is indeed increasing. But if you just use food and energy, that's just two areas. So that's why I like CPI. Both show you a general range, but CPI tends to be more accurate. They fluctuated a bit after a brief recession in 1970, but then surged to great heights. So first in 1974, at the end of 70, after Volk's appointment in 79, inflation peaked and then plummeted rapidly. It has never exceeded 4% on an annual basis. Before Volcker took office as Fed chairman on August 6, 79, the Fed tried small increases in interest rates in hope of taming prices, to little avail. Volcker, as vice chair, was among the hawks in Federal Open Market Committee, pushing for major action. When his chair, William Miller, was appointed Treasury Secretary of Jimmy Carter as part of the cabinet shakeup, Carter named Volcker as Miller's successor. After a couple of modest increases in the first month of his tenure, he called a surprise meeting on October 6, 1979, and set the Fed on a new dramatically tighter course of monetary policy. The Fed allowed a much wider ban on interest rates, allowing them to go higher than before, and announced that it would recalibrate policy regularly in response to changes in the money supply. Remember that all this is corresponding with what happened towards the Bretton Woods, and it was a good decision that he made this surprise meeting because you don't want the market to anticipate these things as soon as what they did. This is actually what Jay Powell, which is the current chair of the Federal Reserve, chairman, and he does a phenomenal job at it. He did the exact same thing as Volcker did in COVID. When everyone was not sure what was going to happen in March, out of nowhere, the market shot up because the next day, people noticed that there was a change throughout the money supply. And that's when people saw the Federal Reserve pumped the most cash injection they ever had been before. And that was a surprise secret meeting that G. Powell did. And G. Powell got inspired from Volcker, because that's what Volcker did in 1979 to deal with this inflation. Why? Because everyone expects inflation, and they're not sure what's going to go. So if you're announcing what you're going to do to people, people are going to respond in a negative way. You have to do it if you're going to do at least something very, in his case, Keynesianism, or surprising decision that no one else has done. In this case, Volcker did the opposite of what Jay Powell did in COVID. He did the opposite of a cash injection. He rose interest rates to a crazy amount ever before. And it's because you need to kill this beast no matter what, which is inflation. And that's what he did. And he did a marvelous job. A lot of people hated him for it because obviously if the interest rates go up higher, people spend less, people earn less, people can't utilize credit as much. People are going to overall have less income, less net worth in the upcoming years. And so many people criticized heavily in Volcker, and Volcker's popularity went dramatically down from this. But years later, these people would come to thank him because he made the right call, right? And finally, that things happen for a reason, right? In order for Volcker to do what he did, all those disastrous pain towards the 70s stagflation, Volcker then decides to, we need to remove this no matter what now, or this is going to become a really big issue in the 80s and going to affect the overall country's economy. So he took action in 1979 by the Fed allowing a much wider ban on interest rates and allowing them to go higher in response with recalibrating policy regularly in response to the changes in money supply from the dislink of gold. If the money supply was growing too quickly, the Fed would crack it down harder. So in that month, the Federal Reserve interest rate was at 13%. Right now, if you look at the interest at 5%. Back then, it was at 13%. By April, it had it spiked at 4 points to 17%. It would near 20% at 1981. Higher interest rates generally reduce inflation by reducing spending, which in turn slows the economy and can lead to mass unemployment. When the Fed raises interest rates, rates on everything from credit card debt to mortgages to businesses' loans all go up. When it's more expensive to take out a business loan, business contract and hire less. When mortgages are pricier, people buy fewer homes. When credit card rates are higher, people spend less and they charge less. The result is overall less spending and thus obviously less inflation, but it also has a slower growth, right? But it's better than all the other situations, all the other options that you have. So you see why many people hated him, because you have a guy that's very hawkish, wanted to raise interest rates to the highest ever, but he was looking towards the long term. He knew this would be a very bad problem if they didn't do something now at a very aggressive rate. And that's what he did. He rose interest rates to a full amount. But by this time, the approach took 2 tries to get it to effect. Volcker's tightening slowed economic activity enough that by January 1980, the U.S. was then into a recession. So that's why that's why the market stayed still. Yeah, that was the reason. The market stayed still was because Volcker in 79, if we get the exact, I wonder if I have the exact month, because I do recall that I did. Let's just look at unemployment. Unemployment in 79 was at 6%. Oh, was at 6%. GDP was at 3.2%. It was dropping down since 76. And I think this is inflation. Yeah, inflation. Inflation was at 13%. Jesus. And then by 80, unemployment went up by 7.2%. GDP went negative, which is a recession. And then inflation went to 12.5%. However, inflation peaked, which many people don't say. Inflation peaked right as Volker did that decision. So it was super necessary, of course, because he stopped inflation. He stopped inflation when he rose interest rates to 17% and he had to raise it to 20%, right? Because ultimately you can see here that it did go down in the next few years. It went from 13% at the highest. And then when he did that decision, it went to 12 and then it went to 8.9 and then it went back to normal inflation, which was 3.8%. But of course, from this decision, when you have higher interest rates, it depends. But in this scenario, when you have high inflation, unemployment goes up higher because you have less spending, less credit utilization, and less income from that. Because remember, what you spend, this is what I learned from Ray Dalio. So I'm going to give credit to him. From what you spend, someone else earns. And from what they spend, someone else earns again. So it's important for people to be spending because it increases the amount of worth as well. When spending reduces and decreases, that person earns less. So the money that you earn is from someone spending, right? So at least in my case, the money that I earn is from someone selling me at a price in the markets that I know is irrational to sell me at that price, but I'm going to take it because it's highly undervalued. So someone else's money in spending is my income. And then by the time I sell at a price very, 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 very high, that's someone else's income, even though it's harder for that person to now make the same income as I did because I bought it very cheap and I sold it very expensive. So this is unemployment. This was inflation. And by 80, obviously it caused a recession because it was obviously from inflation, from going up high, but it was also because of contraction in GDP. It rose the spending and earning from GDP. It doesn't mean that it's gonna make GDP negative, but when you have a combination of inflation and all these other problems corresponding with inflation as well, with interest rates, that reduced the amount of spending, which reduces earnings. By 1980, there was now a recession. 1979, the inflation was at 13%. When was the last time the economy was at 13% inflation? That was since 1946, right after the World War II ended. I mean, that's a different scenario. Look at the GDP. This is worse than what was going on. Well, no, it wasn't worst, but this was really bad. I mean, look at this. It was negative GDP for 3 years. I've never really seen that happen. And here you had negative GDP for 2 years, but not 3 years. Hence, there was a recession. However, like always, the market is not the economy. Despite that there's a recession, there's lower GDP, people are earning less. A lot of people went broke. A lot of hobos now, a lot of homeless people started to become homeless because people couldn't afford homes. People weren't buying homes as much because it was ridiculously expensive. The household earnings and living was less. The household expenses exceeded a lot much because remember, think about if you control a home. If there's less credit yet less utilization, that's going to make that there's going to be less chance and less money for you to reinvest that money into other properties, which meant you have to be dependent on the current properties you have, which you would be more inclined to raise the price so people could still pay you so you could pay your own expenses, or so you could have cash for later on. And this is what the rich do into that. That's where their assets go up. But the poor people, or the middle class per se, who don't, let's say, have the extent of the other person, expenses go up, but their earnings go less because their producer or employer doesn't pay them as much because they don't have the money, because they can't circulate the credit in order to seek new investments to increase the return to pay back their employees. That's what happens to banks too, and that's why many people went broke because they couldn't afford much the house, they couldn't afford much the bills, they couldn't afford much the cars, the things that they bought 20 years ago, and so many people investing into 401ks and all these sorts of things induced, but people were really affected during this time. There was a lot of ignorance on that. But look, out of all these problems, the market bottomed in 80 when there was a recession, right? When there was a recession, and look when the market went up. Look how the market went up. What would I be doing? I would have bought here. 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 All the times it went down. Now, I can't buy the bottom, right? Because I would have bought here, and then I would have bought here, and different ones. And you might be saying like, okay, but how do you know when to buy? Well, I'll talk about that later because that's more technical analysis. But really, as long as you have a set valuation fundamental that it's at a relatively cheap price, you can do well. And if price goes down lower, well, who cares? Because you can't predict, right? When I enter into a position, I'm not saying that this is the position, this is the price is going to stay and it's going to shoot up tomorrow. No, no, no. That's not real life. That's not how the markets work. No one in the world can ever do that. No one can pick a bottom, right? And that's what I'm trying to tell you. Whenever I say that the market, when you get into that position, you shouldn't expect it to go up next week or next month or whatever, next year. You're expecting that the price that you're buying at right now is relatively cheap, that by that time for 3 to 5 to 10 years, the price is going to be extremely far ahead from now. And the price it's about 90% chance that the price won't come back to where you bought it for. But in this case, because we're in the stagflation era, if you bought at 700 in the 70, the price has stayed pretty close to the price you bought. So you haven't made much of a return. But is it because of the market or whatever? No, it's a consequence that happened economically towards 20 years. And you might be saying, okay, is there a way to avoid that? Absolutely not. You can't. Because if you think about macroeconomic, you lose the chance of investing. And if you're wrong about this, because you can be, you have to think about it. You're not God. No one has, no matter if there's a genius or whatever, no one can have the predictability what everyone else in the market is going to do that will reflect the prices and then in fact contra towards the cause and effect of what they're going to do afterwards. No one can predict that. So the best time to really do things is now. If it comes down, you buy more. If it goes down more for the next 2 years, you keep buying, right? If it's a good business. If it right, because you know that the price that you're buying at more, we all saying that when it comes down more, it's likely to go up higher, right? Now, you can't do this with every single market, right? The best markets to do this is for the US. I can't say that this is the case for, I don't know, Israel or Brazil or none of this stuff, right? But the best markets and the only market I advise you to enter is in the US market, right? I would say if you want to get into other markets, please get more experience, more self-experience for yourself that you feel that you see that you're competent at it and you understand the factors and such. But you know the expectations that there's unpredictable measures that you can't control. It's common sense. So you bought here, you bought these other times, and look, the market went up to 1,020 despite the recession. And then by 81, interest rates went from, so by 80, look, the interest rates, it's never gone up that higher. Interest rates by 81 was at set. In fact, this would entice more of a recession because there's less spending. Higher interest rates, it's like tax, right? It reduces your earnings as the person spends less than what you have. They don't have the means to because the government wants more. Towards 81, the market did go down, obviously, because interest rates went from 20%. At a ridiculous level. But you see, out of interest rates and all these amount of fears that people had towards Volker, especially, that's why in 81 this was called the Volker shock, because they had an approach of two tries to get its intended effect. Volker tightening slowed economic activity enough that by January 1980 the US was in a recession, so we know that. But the interest rates actually began falling sharply after April, which limited the effectiveness of the Fed's anti-inflation efforts. The Fed tightened again after that and sparked another recession in July 1981. This was now far worse than the first one, while unemployment peaked at 7.8% during the 1980 recession, and then it would later peak at 10.8% by December 1982, in the middle of the 16-month second Volcker recession. That's a higher level than at the peak of the Great Recession in 2009. Over the course of the 1980s, this policy regime would become as the Volcker shock. When Volcker left office in 87, inflation, look at that. You see? He did an enormous job because of him, from his bold behavior and his staking confidence into, I don't care what people think about me in the short term. I know that this is the right thing to do in the long term, and it's going to help overall for the U.S. to have in a sustainable position where there isn't this high amount of inflation where we really need to deal with it. And so he did by raising interest rates to a bigger level. Now, I'm not saying that if this was to happen again, that raising the interest rates is the best thing to do. Not at all, because it depends. It depends on the situation. Raising interest rates is never the best thing to do. It definitely depends on, let's say, like, what's the approach and what's the goal after this. So that's why predicting either doesn't make sense, and also macroeconomics. Really, the best person, I would say, that has a good estimate but doesn't know, no one knows, but has a better probability than anyone else is the chairman of the Federal Reserve right now, which is Jay Powell. There's no one else in this world who knows what's the U.S. current position globally by economic more than Jay Powell. No one else does because he sees everything. He knows what position we're in. Yeah, I definitely recommend you to look up Jay Powell. I'm not sure if there's any books from him, but if there is, I definitely recommend to read this stuff if you're interested into it. Although I don't think it's, let's say, necessary, absolutely necessary to invest exactly into the market, but it definitely does help. In order to become good at something, you have to know a lot of the things that play around it, especially in finance. So I would say if you can, if there is a book, I don't even know if there is a book by Jay Powell, read it. And if there is a book about Volker, which I'm pretty sure there is, read that too. It's definitely the best thing. That's what I did. Best thing you can do is just revolve yourself around knowledge towards people who have ahead of you from experience and learn from what they responded in current situations. Because that definitely gives you a broader perspective compared to what everyone else is panicking right now, whatever the reason is. So yeah, that's what happened. And he did a great job despite the suffering that happened 2 years from the recession. But in the 80s, it led to a boom. And definitely led to a boom. Look, the GDP per capita went from 0%, negative 0%, to 4 years later to 7.2%. Inflation went down from 13% to 3.9%. Unemployment went down from, well, unemployment stayed the same. Probably from terms in banks corresponding with fear of the inflation to be exponentially over, because that usually happens sometimes. That plays a role in delay over the few years that there could still be unemployment. However, unemployment did slowly go down by each year. It went from 10% to 8 to 7 to 6 to 5. You see, he did do the right call. He made the right decision. And so the market went in a boom. So everyone that was fearful, everyone that thought that the market would be in a complete utter recession for the next 10 years was proving dramatically wrong, right? Because all the people that sold over here missed this new time high gain from 780 to 12 to 1,240. So you see, everyone that bought in 71 are finally seeing a good return of about 100% in 10 years or so. Which, to be honest, that's really good in the terms that what the market and the economy just went through and the consequence. So the person who sold here is now very frustrated looking at this return. And I'm pretty sure everyone's talking about a recession, future panics, and future. Usually when there's a tough situation that's happened a few years afterwards from painful practices, people tend to become more conservative where they don't know where the market's going to go. And they're a bit fearful to touch things. And so when they keep doing this, they start to see that the market keeps going up and keeps going up and keeps going up. And so they start to become depressed in a way. And then they see the market going up and they say, no, I have to buy now. And then they buy at the high right over here and the market goes down. You see? So that's why you don't want to enter when everyone's entering. You need to enter when no one else is entering. Like over here, over here, over here, over here. You see, because you're more sure to get a return than over here. Because if everyone else is entering, remember what happens when everything else is worse? Something much more worse to happen later. That's the same case with something euphorically good. When something is going up 90 degrees, there's less of a chance of something better to come up afterwards immediately. Of course, by human nature, there's evolution, but you can't have 100% gain in evolution from a week ago from now. That's just not how it works. Because people who were complete idiots a week ago are not geniuses now. I know that's a very broad example, but it's a good example. It's like that. It's the same case. If the market's going up, you really think that people are going to become double the genius of what they were here than now? No, they're not. And it has to go back to realistic of what the market should be at, which is the moving averages. And so that's why the market moves up and down, because it has to go back towards the average. Because it's the average. It's the name itself. So you enter here, market went up from this point